In this week's video, we'll show why progress made by the bears needs to be respected. The Fed is always a wild card, and we'll cover areas of potential support that tell us to remain flexible and open-minded. We can learn a lot by comparing last week's video title slide, which we're looking at now, to this week's. Last week, the bullish side of the ledger had the headlines, and the subheading had to do with the bears. So the trends were still in the bulls' favor last week, and the bears had momentum. It's flipped this week. The bears are on top, and the bulls are now hoping that support holds. If you study the markets over time, you'll find that paying attention to what is happening works quite well rather than worrying about what may happen or what you want to have happen. And what is happening currently is the bears have more than just slowing momentum. We'll open the charts with the S&P 500 weekly and cover these bullet points. Then we'll shift gears and look at shorting relative to being long bonds and cover these bullet points. We'll examine the risk-on, risk-off chart that helps us answer the question, would I rather be long or would I rather be short? And we'll cover these bullet points. We'll close out the video by answering the question, how do we take these concepts that we'll be reviewing, summarize them, and turn them into an implementable investment strategy? Said another way, what do we do with all this? To view the video in full screen mode, use this icon in the lower right-hand corner of your video player. To improve the clarity of the charts, use this icon in the lower right-hand corner of your video player. This is a weekly chart of the S&P 500 index in isolation. Purpose of the market model is to recognize incremental changes in the market's profile and to adjust accordingly. As of the close on Friday, August 16th, we have a vulnerable look here where our moving average is. The blue is below the red, which looks similar to this point here where weakness in the S&P 500 followed, and this point here where weakness carried down to this trend line. So the bearish moving average crossover is of concern. However, we have to keep an open mind. Support for the S&P 500 here. Support acted as support soon after a bearish moving average crossover. We're at the same line of support. So it's possible that we get a bounce. From the model's perspective, we don't assume that a bounce will come here. In fact, we assume the opposite. We assume that the short-term momentum in this direction, the bearish direction, will continue. And why do you do that? And why do you take incremental steps away from the market, small steps as we did on Thursday and Friday of last week? You take an incremental step and respect it because you don't know if this bearish moving average crossover will turn into something like this that goes a little bit further, or something like this that carries on for several weeks, or something like the peak in March, between January and March of 2000, where the stock market dropped for 2 years. Or this could be similar to something that happened in October of 2007, where the stock market dropped and didn't find a bottom until March of 2009. Another takeaway that puts a feather in the bear's cap is this is the May closing high in May of 2013. The weekly closing high was 1667 on the S&P 500. This is a bullish breakout here. It's a higher high relative to this high. It somewhat confirms this bullish trend. Now we have a failed breakout on a weekly chart, at least in the short term, What the bulls would like to see is this support to hold and have a weekly close next week or in the coming week above 1667 on the S&P 500 index. This is a weekly risk-on, risk-off chart. This is the S&P 500 index relative to the aggregate bond market or the AGG ETF. When this ratio is rising, stocks are in greater demand than bonds. Here, the demand for bonds is outstripping the demand for stocks. This is risk-on. This is what risk-off looks like. As of the close, Friday, August 16th, we have somewhat of a mixed look here. We have an upward sloping bullish trend channel in favor of owning stocks relative to bonds. However, we're close to getting a bearish moving average crossover similar to this one that occurred in the fall of 2012. This is the ratio here. You can see the S&P 500 was weak after the bearish cross. We don't have the bearish cross yet, and twice in 2013 we've had somewhat of a head fake from this ratio. In late March, early April, we were very, very close to getting a weekly bearish moving average crossover, but the market rallied, so you can make an argument that this look here is very similar to what we have now as of the close on Friday, August 16th. Happened again, another head fake in April of this year, and in both instances, the market rebounded and continued on with the bullish or risk-on trend. This is a little indecisive. However, AGG lost money last week. The stock market lost money last week. What changed was stocks lost more than bonds last week, which is concerning because it looks more like this period here where the stock market struggled for several weeks. Mixed bag here, still within the upward sloping trend channel. Don't yet have the bearish moving average crossover. If this ratio gets down into this area here where the cursor is and we get the bearish moving average crossover, that would increase our bearish concerns. This is another chart that's used in the CCM market model and is also part of the CCM Big Four charts. This is risk on relative to risk off, and in this case we're looking at the S&P 500 relative to shorting the S&P 500, and you might imagine it has a very strong correlation to the S&P 500 itself. We like to look at opportunity cost charts. Would I rather be long? Would I rather be short? It helps us find the best places or buckets for our capital from a risk-reward perspective. What do we have as of the close on Friday, August 16th? This chart looks a little bit worse than the stock bond chart. Has more of a risk-off look. Last week, blue, the exponential EMA3, the weekly moving average closed below the 5-week exponential moving average in red, so you have blue below red, just slightly, 59.25 relative to 59.27, but it did close below. So this period here looks similar to this period here, where the stock market dropped down here. This is the stock market. Or this period here, where the stock market dropped after the bearish cross. We also had a bearish cross recently in 2013, but you can see the market rebounded relatively quickly. This is what a full-bore bullish look looks like. Blue above red, price above both, and the slopes of all of them positive. This is full-bore bearish, blue below red, price below both, and the slopes of all three turning down. We currently have an early stage full-bore bearish look. And as long as this look continues, and if it continues in this direction, we will continue to incrementally step away from risk. For those of you that have followed us for a long time, you know we have multiple models. This chart is used in the CCM correlation model, which feeds into the master market model. The charts rely heavily on price and trends, so the moving averages and price, but they also use numerous indicators, and they're all weighted differently. So if we take a look a little bit deeper in long versus short, here we're looking at momentum, or Williams percent R. And what the model does is when Williams percent R, based on this parameter on a weekly chart, is in overbought territory, not too many bad things tend to happen. This is the S&P 500 right here in isolation. We're overbought, the trend is up. What the model looks for is a move outside of overbought territory, which would be similar to this point here in the spring of 2012. And you can see this is the S&P 500 in black. After we moved out of overbought territory, weakness followed. This line, this dotted line here, shows you where Williams percent R is now in 2013. You can see here when we dropped out of overbought territory, it wasn't as weak as what we're seeing currently. Momentum is stronger here than it is here. The stock market rebounded. When we hit this line here, which is similar to where we are today, weakness followed. When we hit this line, which is similar to where we are today, weakness in the S&P 500 followed. Hit this line, the correction was not yet over. Point of the exercise. This is a yellow flag. It's indicative of slowing momentum in the stock market, and it subtracts from our models and tells us to start stepping away incrementally. We can also look at an indicator, and these indicators that we're looking at, Williams percent R is based on the ratio of being long versus short. And when we look at the true strength index here, TSI is derived from the ratio of being long versus short. So we're looking at an indicator for the ratio. Typically what you'll find on TSI, good things tend to happen when the black line is above the red line. Black above, S&P 500 has a bullish trend. Bearish probabilities or odds start to increase when you get a bearish crossover where black drops below red, as it did here. You can see weakness followed in the S&P 500. Here's the S&P here where the cursor is. Bearish crossover, weakness followed. You can get somewhat of a head fake, bearish crossover, market recovered soon thereafter and went up. You can also use a momentum indicator like TSI divergences come into play. So here we have a clear momentum divergence that's been developing in 2013. This is the S&P 500 here. If you compare the slope of this orange dotted line for price to the slope of the momentum indicator, price is making a higher high here in 2013, and the momentum indicator is making a lower high. That's a bearish divergence. If you're a bull, you'd like to see that cleared up in the weeks ahead. If you follow the markets closely, you know that the stock market and bond market have been falling in unison, so this is a little bit different look. What this looks at is we're comparing more conservative or risk-off alternatives head-to-head. This is shorting the S&P 500 relative to being long the aggregate bond market. So what you're comparing is, would I rather be short the stock market or would I prefer to be in bonds? You can see when the ratio rises, this means shorts are outperforming the bond market, and the stock market here in black tends to do poorly, which makes sense. If your number one alternative is shorts are performing better than bonds and they're performing better than the stock market, that's full bore risk off. Here, the ratio rises, you get the full bore bullish look for being short relative to bonds. So this is risk off here. Stock market does poorly. We're in somewhat of a mixed bag or neutral territory here. Why? This is a bullish look for being short relative to the bond market. So this is risk off in terms of its look. However, Like the first chart we looked at, there's potential resistance here in the picture. Shorts outperformed bonds last week. However, here, that ratio was rejected and fell. And you'll notice when this ratio here in the upper left-hand corner was rejected by this red line, which acted as resistance, the stock market found its footing and began to rise again here. In a similar vein, shorts are the number one position here. Right here where my cursor is, you'd rather be short than own the bond market, and you'd rather be short than own the stock market. This is where that trend changed. If we draw the red line coming down, it acted as resistance for this ratio. The ratio was rejected here, and after that point, if I bring my cursor up, the stock market bottomed and did well. So we need to keep an open mind here. This looks bearish for the stock market, and it looks as if shorts are the place to be. But we need to see what happens at this red line where the ratio was rejected here, and after that, strength in the stock market followed. We just looked at a lot of stuff which can be extremely confusing. We looked at the S&P 500 weekly and some indicators associated with that chart. We looked at a long versus short chart and indicators associated with that chart. Stocks versus bonds and indicators. And being short versus bonds and a set of indicators associated with that. How do we use it all? As we mentioned at the open, how do I convert concepts into an implementable investment strategy? That's what the market model does for us. The CCM market model uses 5 separate inputs. We use the correlation model as an example, and we'll close with the current readings of the master model. The CCM correlation model uses 18 charts. These are the 18 charts that we track. Each chart has a series of indicators that we track and have weighted accordingly. We can boil all of this down to a single number. This is the single value for the correlation model as of the close on August 16th. Then the correlation model and the other models are used as input here for the master market model, which ultimately gives us a recommended exposure to risk and a recommended exposure allocation-wise to conservative assets. The recommended allocation as of the close on Friday, August 16th, was a 66% exposure to risk and a 34% exposure to conservative assets. As of the close on Friday, we were at 74% on the risk side. So if weakness carries into the coming week, we'll be quick to reduce exposure again. We reduced exposure on Thursday and again incrementally in most accounts on Friday. We wanted to see how the support that we've discussed in this week's video, whether or not that support held. Again, if weakness carries into the new week, we'll continue to take incremental steps away from risk. If you've been following us on Twitter, you know that we've been looking at this Dow daily chart, which again is part of the CCM risk model. We've noted that trend line B here or trend line C may potentially act as support as well as the 50-day moving average. The 50-day has not acted as support. We've closed well below it. Trend line B, we've closed below that as well. But here's your bullish breakout in the month of July. Acted as resistance, bullish breakout. We could be coming back to test trend line C, and it may act as support, which was one reason for a little bit of patience on Friday and allowing our accounts to remain a little bit over allocated for a day or so to see what happens at this support level. If this gives way, we have an upward sloping parallel bullish trend channel here where the Dow Jones Industrial Average may find support at the lower pink trend line. The material in this video has no regard to the specific investment objectives, financial situation, or particular needs of any viewer. This video is presented solely for informational purposes and is not to be construed as a solicitation or offer to buy or sell any security or any related financial instruments, nor should any of the content be taken as investment advice. Any opinions expressed in this video are subject to change without notice, and Shavaco Capital Management, LLC, or CCM, is not under any obligation to update or keep current the information contained herein. CCM and its respective officers and associates or clients may have an interest in the securities or derivatives of any entities referred to in this material. CCM accepts no liability whatsoever for any loss or damage of any kind arising out of the use of all or any part of this material. We recommend that you consult with a licensed and qualified professional before making any investment decision.